And thanks for joining us this morning.
Thanks, Deb.
And also joining us this morning, Steve Miller, Head of Fixed Income at BlackRock Australia, and AFR Chanticleer columnist Tony Boyd. Good morning to you both as well. So, Steve, are you as bearish as Gerard? What do you reckon?
Oh, I think Gerard's right insofar as this is, I think, a corrective move. It's not, a harbinger of something more dire. I think he's also right when he sort of says what markets are trying to wrestle with is we get the end of quantitative easing at the end of this month, and we don't really know what's going to take its place. And, I don't think the Fed knows what is going to take its place. I don't think markets know what the Fed's doing. And I think markets are cottoning on to the fact that the Fed doesn't know what it's doing, and markets are thinking that the Fed doesn't know what it's doing is engendering all this uncertainty.
So that's all adding to the confusion.
Exactly.
But we're seeing green shoots in the US economy. Is that going to be enough to steer around other soft parts of the global
I believe so. I think the growth momentum in the US economy is quite solid. I think the US economy is fundamentally sound, and I think that will, that'll be the influence that is most predominant going forward, notwithstanding all these uncertainties about, Fed policy.
And how much of an unknown, Tony, is the Ebola crisis in all of this? Because we know that the markets do react to health scares. We've seen it into SARS. But really, we don't know how much of an impact Ebola is going to have.
Look, a full-blown epidemic of Ebola would be absolutely catastrophic for the world, especially in densely populated areas in Asia. But I think this is just one of many things on the minds of investors. The Barron's Big Money poll came out this weekend. It said that 59% of America's big fund managers are either bullish or very bullish. They think the Dow will go up by 12% by the middle of next year and the S&P 500 by 15%. So I think amid all this, you've got to go and think about where's the money going to flow. And basically, it's into equities because they offer a good return. And in Australia, particularly, with high yields, we have some of the highest yields in the world in terms of equity returns. And that's not going to change. And
there are always upsides, aren't there, to sell-offs too?
Well, I mean, one of the things that's happened is 20% fall in the oil price in the world. And I read a great article in the FT. Daniel Yergin, who's the world guru on oil, said that if oil stays at $80 a barrel for a year, that's $160 billion in the pockets of US consumers who drive cars. I mean, that's a fantastic kick to the US economy.
Glass half full rather than empty. And you manage, Steve, $16 billion in bonds. You've got a lot to play with. Where would you be investing at the moment?
I think at the moment, we are sort of seeing markets are quite fully valued. In terms of, where I'd be looking to park some money is in things that aren't dependent on market returns. So they're not dependent on bond returns. They're not dependent on equity returns. We're looking for sort of total returns and flexibility. So this might be flexible or unconstrained bond funds that can go anywhere. This might be hedge funds that aren't correlated with equity market or bond market returns. This might involve too, paying a little bit away for liquidity and investing in illiquid but high returning assets such as infrastructure assets. They're the sorts of things that I'd be looking at.
Looking for the long term rather than the short buck.
Exactly. You want to be in the market for the long term rather than, just play around.
Good tips there. And we'd love to hear from you on this as well. Join the conversation with the hashtag FRSunday. Up next